Hey, good afternoon, everybody. Welcome to the podcast. Thanks for joining me. Stock market is closed now, and as you can see from the screen, we've got a little, well, I was going to call it red, but it's not red. It's actually black. Maybe I need to change my settings. But anyways, okay, let's put it this way. We have some minus signs. So there's some minus signs on the screen that we haven't seen in a while. In fact, we saw way more than average, and I say average in the last 2 weeks, way more volatility than average. The Dow Jones was up about 60 or 70 at one point and finished down on the day about 68 points, about 0.5%. As you can see, transports were flat on the day. Utilities down just as much as the market. The NASDAQ down about 9 points. Russell 2000 pretty flat. Small caps actually up a little bit on the day, and the financials up on the day. So for those that are bullish, we'll get into why you may be a little concerned right now. And for those that are bearish, I would say, hey, look at this. You got the Russell, and you have the transports outperforming, mid caps outperforming, the S&P and the NASDAQ and the Dow, which was a complaint on the way up from some of the bears. So take a look at that. So there's a little something for everybody in today's market. So let's start with the S&P. Over the weekend, I did the podcast. I guess it went out Friday evening, and I mentioned the fact that we could see at some point a fake-out breakout. And I discussed that term because what I was looking for is potentially a move above this area here, which is the old high, a move above that, and then which we got today, and then a reversal. And that is exactly what we got. We had a move higher, and I really thought you would see volume really pick up as soon as we saw that move above the old high. And what you saw actually was you did see the reversal, but it wasn't really on tremendously heavy volume at that particular time in the day. So we saw a big change in direction throughout the day, and in fact that happened with a few other stocks as well, where they made new highs and then they reversed to close lower on the day. Now the S&P, down 5 points, not a huge move, but again, when you consider the highs and lows of the day, and from where we were last night, it's a bigger move than we've seen in a while. Now put the Dow Jones on here, and if we look at the Dow Jones, you can see, and this is starting from the uptrend that really started back in early June. We'd been zigzagging back and forth, of course, and in the last maybe 10 or 12 trading days, we've had these very narrow bands. In fact, I put a little indicator up here. I just changed the color for you so you can see it made a little thicker. But it's the range of the Dow Jones each day. So, and what it does is it doesn't necessarily just look at the intraday move. It takes into consideration the move from the prior day close as well. Because sometimes you get these gap ups, right, where the stock market opens up 50, and let's say it closes up 50. Most people would say it didn't move that much that day. Well, we want to see that 50 points is in there. We also want to see that it moved from high to low. And so what you're seeing here is that it basically had a 144-point swing from the high of the day to the low of the day. And that's a big move. In fact, I mean, we had been going down really more in the 40, 50-point range. And again, this number includes, this line includes the previous day's close as well. So this calculation is really the culmination of different indicators rolled into one, and it takes the greatest move and the biggest move. And so, when you're seeing a move of 45 or 50 points, that's taking into consideration the previous close, the highs and lows, everything. So it was very low. Now we're getting back to not even average, really. I mean, the average was much in the 200 range for the last 2 or 3 months. So we were very, very low, this tight range, as you can see right in here. And now today we had this kind of reversal. So here's the reversal we're talking about. So we have the opening right around here. Stock market is running up, new high. You start to see kind of a ramp up. I think we're up 60 or 70 on the Dow at that point. And then we saw the selling come in, and it really persisted all the way through the close. And why that's important is for several reasons. Number one, many technicians look for these types of reversals and kind of these, what they call a bearish engulfing pattern. And basically what it means, it's this bar is engulfing this one previous to it. And so you had the higher intraday move, fresh new high, all-time high, and then it reverses. And when I say all-time high, post-crisis high, this is the highest we've been past 2009 during the recovery. So it was something to watch for that reason. In addition to that, a lot of technicians would be pointing to the double tops here. Now we have two of them potentially. And so what I had pointed out in the previous podcast was the obvious trade would be potentially a breakout above this, and all this buying comes in and off we go. But I warned you that be careful of the fake out breakout, where we break out, you buy a bunch of stuff only to see it come back down into this. So where does that leave us now? It wasn't a huge reversal. It wasn't like we were down 300, 400 points on the day, but it was something we haven't seen in a while. So you do have to pay attention. Don't forget we have Jackson Hole next week. So again, people are hoping that the Fed comes out and does some kind of quantitative easing. When I say the people, I'm not necessarily saying you want that or I want that, but general consensus would be that quantitative easing has been baked in the cake here, and the market has been wanting that. And if Bernanke disappoints, then down we will go, and maybe we will. So be very, very careful over the next couple of weeks in your trading. Again, buying very specific things is fine. I would be rotating out of some things that maybe look vulnerable. So if they've had a nice run since the June low and they are showing signs of slowing down, and there's several technical indicators to show you that momentum slowing. If you see that, take the profits, and you can take the profits in those things and just keep your powder dry, because hopefully if you're a bull, what you're wanting is that, and you're wanting to get more cash allocated, maybe we get a pull back down to somewhere here, and then we resume up again, and maybe that's the the 100-day moving average, or maybe by that time it happens, the 200 days working its way higher, somewhere in this time frame or this area there. This is where maybe a good buy spot would be, again, if this trend is continuing. But be very careful the next couple of weeks, because the markets are going to move one way or the other, and the volatility may start to pick up. So be careful of that. Let's switch to Apple real quick. Kind of a similar situation where it broke out, and you could have almost an identical situation to the S&P 500, where, again, we had a double top here, and it broke out, and now it's reversing. And it reversed, as you can see down here, on higher volume. So the bears are going, aha, you see? Well, not so fast. I think Apple's a little bit different situation than the S&P. And the reason I say that is because I think much better clarity on the situation going forward for Apple than I do on the S&P 500. Remember, people that are calling for the S&P 500 at 1,500 or 1,600, the way they get there is way too simplistic for my taste. They say, hey, we think the S&P as an aggregate can have earnings that are maybe $100 for the whole entire S&P 500. We think people will pay 15 times those earnings, 15 times $100 per share. That gets us to an S&P 500 of 1,500. I've heard that today. That seems a little simplistic to me. It may get to 1,500, but I don't know if it's going to be necessarily because I am willing to pay 15 times earnings and you're willing to pay 15 times earnings for the entire market. At least my brain doesn't work that way, and sometimes doesn't work at all. But if we also look at Apple, the thing that we are noticing here is that it didn't engulf the whole pattern. In fact, it actually didn't quite close on its low. So that's another kind of, again, bullish, or I should say it's lacking full bearishness. But the thing is, it's starting to run. People are starting to chase it a little bit. And you got a downgrade in the middle of the day by, frankly, a firm that I had never heard of. And they're downgrading. I think they downgraded them based on some margin compression. They worried about some of their margins becoming smaller, profit margins. They could be just making a name for themselves, right? You got a company in the middle of the day. Everybody's loving Apple. It's at new highs, and they say, hey, we're going to downgrade it. And they get all this press all over the news. That could be a likely scenario. It is refreshing, though, I will admit, to have a company come out and downgrade a stock as loved as Apple at a high. How many times do we see a stock get downgraded at a low? They actually came and downgraded Apple at a high. So, hat tip to them, but we'll see how it plays out. Again, I'm a little suspect that they potentially did it for marketing purposes. Now, I've switched this to weekly, and I think I pointed this out in the last podcast to some degree, but Apple has been one of those stocks that is a stair stepper, I call it, where and I'm only going back to 2010, but it moves up, moves sideways for a few months, moves up, moves sideways for a few months, moves up, moves sideways, and this pattern continues, and it's doing the same thing, and now it may be breaking out. If you look at something like this and you put the Bollinger Bands around them, which for those that are new to the podcast, I don't have a set of, this is my go-to, I use these 3 indicators and that's it. I look at everything, and some indicators work better at certain time frames. Certain indicators look better on certain stocks. But I look at it all and then try to find a pattern for that particular stock at that time. And what I'm noticing with Apple on a weekly picture is you notice that when these bands get very narrow, for example, here and here and here and here, and now here, once they start to widen out, because Apple's starting to move, it's generally to the upside. So if this was a daily picture, you may look at this and say, hey, Apple's just about to take off. So by us looking at it on a weekly picture, remember, this is weekly, each bar is a week, it looks like it's at the beginning of a run, not the end. So do you want to buy it tomorrow? Maybe not. Let's see it stabilize. I've owned it off and on. In fact, I've owned it really once it broke out of this little downdraft it was in. I had sold it somewhere back in here, sold a little bit too early. I had I think well over 120, 130% profit. Sold it. Apple came down, and then once it broke out, I bought it back. And now I think we may be up another $100 or so on it. So I'm continuing to hold it. I'm buying it more for a fundamental reason. I do like the technicals. I like the fact that it broke out. And again, right when it reversed, everybody said, aha, here it goes, it's heading down. But keep in mind, this is not a high-flying company that sells burritos. No pun intended to Chipotle Mexican. Well, yeah, pun intended to them. I was actually talking about them. Chipotle Mexican Grill, selling burritos. What kind of multiple can you put on that? I don't know what the enough burrito jokes. We've done those in the past few podcasts. But look, they're going to sell a lot more Apple products. They got 3 products coming out, and they're going to continue to grow. At some point, there's going to be the law of large numbers, right, where this company can't grow as fast as they have been. That will happen to Apple. But just keep in mind that, when you look across the board at this company, they still have a lot of great things going for them, and they're not overly priced. Could their PE drop from, 14 to 13, which means the stock may drop, 8%? Sure, that can happen. But you're not talking about a PE ratio of 50. They have a ton of free cash flow. They're just a great managed company. And the jury's out what this company will look like 5 or 10 years from now. I'm not saying I'm going to put it on the shelf and, gift it to my kids and they'll be millionaires. We don't know what's going to happen to Apple. But I think it is still in the sweet spot of, and I think at some point it will reach $1,000 a share, whether they split or not, who knows. But I think it will reach that because they still have a lot of things that were in the pipeline that Steve Jobs wanted to get accomplished, and I think they'll get accomplished. So that's my take. And don't forget, they still have over $100 billion of cash, so they can run out there and acquire basically anybody they want, and or companies. There were some rumors last night that they were going to possibly look at acquiring TiVo, and if they wanted to get into the television market, that might be a good acquisition for them. So who knows? We'll see if that comes to pass. But that's the latest take on Apple. All right, guys, I'm going to keep this short tonight. I have an appointment to run to. Apologize for that. But again, keep in mind that the market's could be very turbulent over the next couple of weeks. Got some big headline items coming out, and obviously this double top that we may be approaching right here. So don't forget KarlEggers.com, EggersCapital.com, Twitter, Facebook, Google+, all of those were on there. Have a wonderful evening. We'll talk to you soon.